Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss two group discussion topics related to the internal promotion examination for banks. Welcome to part 11 of my Path to the Corner Office 2025 to 2026 series, where we break down real bank promotion exam questions and give you clear, practical sample answers about group discussions to help you climb the career ladder faster. So, group discussions topics: cryptocurrency, threat or opportunity for banks, post pandemic banking trends in India. Cryptocurrency, threat or opportunity for banks. Cryptocurrency has emerged as one of the most disruptive innovations in modern finance. Built on blockchain technology, cryptocurrencies such as Bitcoin, Ethereum, and stablecoins promise faster transactions, decentralization, transparency, and global accessibility. For banks, cryptocurrencies present a paradox. They challenge traditional intermediation and payment models while simultaneously offering new avenues for innovation and growth. Whether cryptocurrency is a threat or an opportunity for banks depends largely on regulation, market volatility, fintech led disruption, and the pace of digital adoption. A balanced assessment is necessary to understand how banks can navigate this evolving landscape. Opportunities and positives and arguments in favor of cryptocurrency for banks. First, catalyst for digital transformation. Cryptocurrencies have accelerated digital adoption across the financial ecosystem. Banks are compelled to modernize legacy systems, improve real time payments, and adopt blockchain based solutions. This pressure has led to faster innovation, improved customer experience, and operational efficiency. By learning from crypto platforms, banks can offer instant settlements, 24/7 services, and lower transaction costs. Second, new revenue streams and products. Cryptocurrency opens opportunities for banks to develop new services such as crypto custody, trading platforms, tokenized assets, and advisory services. Institutional clients increasingly seek secure, regulated custody solutions, an area where banks have a natural advantage due to trust, compliance, and risk management expertise. Tokenization of assets like bonds, real estate, and commodities can also create new fee based income. Third, blockchain for back-end efficiency. Even without dealing directly in cryptocurrencies, banks can leverage blockchain technology to improve reconciliation, cross-border payments, KYC sharing, and trade finance. Distributed ledgers reduce settlement time, enhance transparency, and lower fraud risk. These efficiencies can significantly reduce operating costs and improve scalability. Fourth, financial inclusion and global reach. Cryptocurrencies and related technologies can support faster and cheaper cross border remittances, benefiting migrants and businesses. Banks that integrate crypto rails responsibly can expand their reach to underserved markets and offer inclusive financial solutions while maintaining regulatory oversight. Fifth, competitive response to fintech disruption. Crypto native fintechs have raised customers' expectations for speed, cost, and user experience. Banks that engage with crypto innovations can remain competitive by partnering with fintechs, adopting APIs, and offering hybrid solutions that combine innovation with trust and compliance. Threats and negatives and arguments against cryptocurrency for banks. First, disintermediation risk. Cryptocurrencies enable peer to peer transactions without intermediaries, challenging the core banking model. Decentralized finance platforms offer lending, borrowing, and trading services without banks potentially eroding fee income and reducing banks' role in payments and settlements. Second, regulatory uncertainty and compliance burden. One of the biggest concerns for banks is the evolving and fragmented regulatory environment. Different jurisdictions treat cryptocurrencies differently, creating compliance complexity. Banks operate under strict KYC or AML and consumer protection norms, while many crypto platforms operate with lighter oversight. This asymmetry creates risk and uncertainty for banks entering the space. Third, high volatility and risk exposure. Cryptocurrency markets are notoriously volatile. Sharp price swings pose risks to investors and institutions alike. Banks that offer crypto-related services that face reputational risk, potential losses, and heightened risk management challenges. Volatility also limits cryptocurrency's usefulness as a stable medium of exchange. Fourth, cybersecurity and operational risks. Crypto ecosystems have been targets of hacks, frauds, and operational failures. Custody of digital assets requires advanced security infrastructure. Any breach can severely damage a bank's reputation and customer trust. Fifth, consumer protection concerns. Many retail investors lack adequate understanding of crypto risks. If banks are seen as endorsing or promoting speculative assets, they may face backlash and during market downturns. Mis-selling allegations and legal disputes could arise if risks are not communicated clearly. Regulation, constraint, or enabler. Regulation sits at the heart of the crypto debate for banks. On one hand, strict regulations increase compliance costs and slow innovation. On the other, clear and consistent regulation can legitimize crypto activities and level the playing field. Banks thrive in regulated environments because they are built to manage compliance, risk, and governance. Well defined rules around custody, stablecoins, AML, taxation, and consumer protection can turn crypto from a threat into an opportunity by pushing out unsafe actors and enabling banks to offer trusted services. Central bank digital currencies further illustrate this balance. While not cryptocurrencies in the traditional sense, CBDCs reflect how regulators and banks can adopt digital currency concepts within a controlled framework, preserving monetary sovereignty and financial stability. Fintech disruption and digital adoption. Fintech and crypto platforms have redefined customer expectations. Instant onboarding, seamless apps, low fees, and global access. Banks that resist this shift risk losing relevance, particularly among younger tech savvy customers. However, banks possess strengths that fintechs often lack: trust, scale, balance sheets, and regulatory expertise. By adopting digital first strategies, partnering with fintechs, and selectively integrating crypto services, banks can combine innovation with stability. Digital adoption driven by crypto has also improved data analytics, automation, and open banking. These capabilities help banks improve credit assessment, personalize offerings, and enhance risk monitoring benefits that extend beyond crypto. Balanced comparison: threat versus opportunity. Cryptocurrency is a threat to banks when viewed fully as a fully unregulated, volatile, and parallel financial system that bypasses intermediaries. It challenges traditional revenue models, introduces new risks, and raises complex regulatory questions. However, it becomes an opportunity when banks engage with it strategically, leveraging blockchain for efficiency, offering regulated crypto services, and using their strengths in compliance and trust. The key distinction lies in how banks respond, ignoring crypto risks, obsolescence, embracing it recklessly risks instability. It, a calibrated approach focused on regulated products, institutional services, strong risk controls, and customer education allows banks to capture upside while limiting downside. Arguments for cryptocurrency as an opportunity for banks drives digital transformation and innovation, creates new revenue streams like custody, tokenization, advisory, improves backend efficiency via blockchain, enhances cross border payments and inclusion, enables competitive response to fintech disruption. Arguments against cryptocurrency as a threat to banks. Disintermediation through DEFI and P2P models, regulatory uncertainty and compliance complexity, high volatility and reputational risk, cybersecurity and operational challenges, consumer protection and mis-selling concerns. Conclusion: cryptocurrency is neither purely a threat nor purely an opportunity for banks. It is both. In the short term, it disrupts traditional models, introduces volatility, and raises regulatory and operational challenges. In the long term, it offers banks a powerful toolkit for innovation, efficiency, and customer centric services. The decisive factor is regulation and strategic intent. Banks that adopt a cautious yet proactive approach, focusing on regulated offerings, robust risk management, fintech partnerships, and customer education, can transform crypto driven disruption into sustainable growth. Conversely, banks that ignore crypto or pursue it without safeguards risk losing trust and relevance. Ultimately, cryptocurrency represents a transition phase in the evolution of finance. Banks that balance innovation with responsibility, digital adoption with stability, and opportunity with risk management will not only survive this transition but emerge stronger in a rapidly digitizing financial world. Post pandemic banking trends in India. The COVID 19 pandemic acted as a major turning point for the Indian banking sector. Lockdowns, mobility restrictions, and social distancing norms disrupted traditionally banking operations and forced banks and customers to rapidly adopt digital alternatives. What might have taken a decade happened what might have taken a decade happened in a matter of months. As India emerges from the pandemic, several structural changes in banking have been permanent rather than temporary. Key post-pandemic trends include accelerated digital adoption, rationalization of physical branches, then and significant shifts in customer behavior. While these trends have enhanced efficiency, accessibility, and resilience, they have also created challenges related to cybersecurity, financial inclusion, employment, and customer trust. A balanced evaluation is therefore essential to understand whether these trends strengthen or strain the banking ecosystem. Digital adoption, opportunities and positives. One of the most significant post pandemic trends is the rapid adoption of digital banking. Mobile banking apps, UPI, internet banking, digital wallets, and contactless payments became the primary mode of transactions during the pandemic and continue to dominate today. From a positive perspective, digital adoption has improved convenience and accessibility. Customers can now open accounts, transfer funds, pay bills, apply for loans, and invest without visiting a branch. This has saved time, reduced transaction costs, and increased overall efficiency. For banks, digital platforms have lowered operational costs. Digital transactions are far cheaper than branch based transactions, enabling banks to improve profitability. Automation, AI driven chatbots, and straight through processing have reduced dependency on manual intervention. Digital adoption has also accelerated financial inclusion. Through UPI, Jan Dhan accounts, and mobile banking, even small merchants and rural users have entered the formal financial system. Government benefit transfers have become faster and more transparent, strengthening trust in digital finance. Moreover, data generated through Digital transactions allows banks to analyze customer behavior, improve credit assessment, personalize products, and manage risk more efficiently. Digital adoption challenges and negatives. Despite its benefits, digital banking also presents several challenges. The most serious concern is cybersecurity risk. As digital transactions increase, banks face growing threats from fraud, phishing, hacking, and data breaches. Any security lapse can severely damage customer trust and financial stability. Another issue is the digital divide. Elderly customers, low income groups, and people in remote areas often lack smartphones, internet access, or digital literacy. Excessive reliance on digital platforms may unintentionally exclude these groups from essential banking services. There is also overdependence on technology. System failures, server outages, or technical glitches can disrupt services nationwide, affecting millions of customers simultaneously. Additionally, many customers feel a loss of personal touch, especially in complex services like loans, grievances, or financial planning, where human interaction remains important. Branch reduction, opportunities and positives. Post-pandemic, many banks have begun reducing or rationalizing physical branches, focusing instead on digital and hybrid service models. This trend is driven by declining footfall, high operating costs, and increased digital adoption. From a positive angle, branch reduction helps banks optimize costs related to rent, utilities, staffing, and maintenance. Resources saved can be redirected towards technology upgrades, cybersecurity, and product innovation. Banks are also shifting from transaction focused branches to relationship oriented branches. Physical branches now handle advisory services, high value customers, and complex financial products rather than routine transactions. This trend improves operational efficiency and allows banks to remain competitive against fintech companies that operate with minimal physical infrastructure. Branch reduction challenges and negatives. However, branch reduction also raises concerns. In rural and semi urban areas, branches are often the primary access point to banking services. Reducing branches may affect senior citizens, farmers, and digitally excluded populations. Branch closures can also lead to employment concerns as traditional banking roles shrink. Staff need reskilling, redeployment, or risk redundancy, creating workforce anxiety. Furthermore, during emergencies, disputes, or high value transactions, customers still prefer face to face interaction. Excessive reduction of branches may weaken trust and accessibility. Customer behavior changes, positive trends. Post pandemic, customer behavior has undergone a fundamental shift. Customers have become digitally confident, preferring self service channels over physical visits. Even traditionally conservative users have adopted UPI, mobile banking, and online investment platforms. There is also increased demand for speed, transparency, and personalization. Customers expect instant loan approvals, real time updates, and seamless service across channels. Another positive trend is growing financial awareness. People are more conscious about savings, insurance, emergency funds, and investments after witnessing economic uncertainty during the pandemic. Customers are also more open to fintech collaborations using apps for payments, investments, and credit alongside traditional banks. Customer behavior changes, negative aspects. On the negative side, customers now have lower tolerance for service failures. Any downtime, delay, or error leads to dissatisfaction and rapid switching between service providers. Digital dependence also increases the risk of fraud and mis-selling, especially for less informed customers. Many users fall victim to scams due to lack of awareness. Additionally, customers expect 24/7 service, putting pressure on banks to maintain uninterrupted systems, quick grievance redressal, and strong back-end support. Balanced comparison. The post-pandemic banking landscape in India reflects both progress and pressure. Digital adoption has transformed banking into a faster, more inclusive and cost-efficient system. Branch rationalization has improved operational efficiency, while customer behavior has evolved towards digital-first, informed and demanding usage. However, these benefits come with challenges such as cybersecurity risks, digital exclusion, employment concerns, and erosion of personal relationships. Over digitalization without safeguards can weaken trust and inclusivity. The key lies in a hybrid banking model where channels handle routine transactions and branches focus on advisory, trust building, and complex services. Technology should complement, not replace human interaction. Arguments for post-pandemic banking trends: faster and more convenient banking services, reduced operational costs and improved efficiency, increased financial inclusion through digital platforms, data-driven decision-making and personalized services, better resilience against future disruptions. Arguments against or concerns: cybersecurity and fraud risks, digital divide affecting vulnerable groups, reduced employment and branch accessibility, loss of personal banking relationships, over dependence on technology. Conclusion: post pandemic banking trends in India represent a structural shift rather than a temporary adjustment. Digital adoption, branch rationalization, and changing customer behavior have made banking more efficient, accessible, and resilient. At the same time, these trends pose serious challenges related to cybersecurity, inclusivity, workforce adaptation, and customer trust. A balanced approach is essential. Banks must strengthen digital infrastructure while investing equally in cybersecurity, financial literacy, and customer support. Branches should evolve, not disappear, and serve as, as trust centers rather than transaction points. Customers must be educated to use digital services safely and responsibly. In conclusion, post-pandemic banking trends are largely positive and inevitable, but their success depends on balanced implementation. Banks that combine technology with human touch, efficiency with empathy, and innovation with security will lead the future of Indian banking and ensure sustainable growth in the years ahead. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.